All right, thank you for having me, guys. Actually, this has been something I've been working on a lot lately, just kind of as Timothy mentioned. I get a lot of questions from real estate agents, title reps, or just, regular people who have like kind of read what I've been putting out there about Prop 19. And it's kind of this new thing that's going to be hitting the ground here relatively quickly. So I'll kind of get into the due dates. I'll get into what it is, what the changes are, and how it's going to affect people, then how you can actually plan for it as well. Just as a little side before I think we get started. So as Timothy mentioned, my name's Alton Moore. I'm a CPA. I'm an attorney based here in Orange County. I do a myriad of things, but I do a lot of everything's kind of centered around the tax function, right? So tax preparation, tax planning, and whether it be income, property, estate planning as well. So if you guys ever have a question, feel free to reach out. And as we get started, I like to start these presentations with, giving you a message or something to keep in mind. Really, the purpose of this presentation is to provide you value for your clients, right? So what I want to be able to do is give you a few talking points, or at least be able to identify the issues that are going to be surrounding the changes that are forthcoming with Prop 19 here in the coming weeks and months as well, because you'll see there's various timelines or deadlines that are different for the various changes that are brought by California Prop 19. So, all right, so we'll be covering what Prop 19 is, and then the changes that's bringing to the property tax reassessment exemptions for parent to child, grandparent to grandchild, and then those that are available for seniors and victims of natural disasters. And I guess before I get too deep into this, I understand these topics very well, so I tend to rapid fire. So if you guys ever have questions, feel free to speak up. Just go ahead and stop me. I'm happy to answer your questions or shoot them in the chat, and I'll try to catch them as well as I go on. So, all right, let's get right into it. All right, so what is Prop 19, guys? So it was a California ballot proposition that appeared in the general election back in November of 2020. And generally, from a high level, what it does, it increases the property tax burden for transfers between parent to child, grandparent to grandchild, and loosens those requirements or exemptions for seniors and victims of natural disasters. What we needed is a more than 51%, I think it was 50 or 51% vote to pass this. And it passed by the slimmest of margins with 51.09%. So, there's a lot of people on both sides. I'm sure you guys read the descriptions if you were voting last year, just about what it was intended to do and how it was going to allocate revenue between different victims of natural disasters as well. And beyond that, what the legislature has also said it was meant to do was to increase California's tax revenue to the tune of hundreds of millions of dollars per year. And I thought it was kind of funny. One of the tidbits that they put inside there is that it was also to combat abusive transactions by East Coast people who are taking advantage of California's favorable tax laws, which I don't know if you guys know, California is already one of the highest tax states, and the East Coast people don't get a break. So it's kind of just a funny reasoning as to why they also passed this. All right, so let's dig right into it. So the first thing that we're going to talk about today are the changes to the parent to child and grandparent to grandchild property tax reassessment exemptions. And so I'm going to go through how they are and then how they've changed. And really, they've changed with respect to the principal residence and then other property, which can be, vacation home, rental home, or just other real property a person might own and pass on to their children. All right, so the first change that they brought about, or that they have in Prop 19, is for property tax reassessment exemptions for the principal residence of a person. So before the passage of Prop 19, a person could transfer their principal residence to their child or their grandchild without incurring a property tax reassessment. The property could be of any value, and the child or grandchild did not have to move into that house as their principal residence after receiving it. So that's important to note, because now after the passage of Prop 19, this is changed radically. So now a person can transfer their principal residence to their child and or their grandchild without incurring a property tax exemption up to certain value limits, which is, the current property tax basis plus $1 million of fair market value. And after that, the actual child or grandchild who's the recipient of the property has to move into that house as their own principal residence. And finally, they have to claim this exemption, this limited exemption, within a year of the actual transfer. So let's kind of talk about, what's that value? How does that value actually play into it, and how do they reassess it if you kind of go above that threshold I'm talking about? It's easiest just to flesh these things out with an example. So we'll go with one that I have inside the deck here. So let's assume you have a parent who back in 2000 was smart. They buy in Crystal Cove. They're able to buy a house for $500,000. And so for purposes of this example, let's assume there's no reassessments along the way. We get to March 2021 and they pass on, right? And now that property is going to transfer to their child. Well, at the time of their passing, the property is now worth $1.75 million. So how are we going to recalculate this property tax exemption, assuming that the child actually moves into the house as their principal residence? So you're going to take their current property tax basis of $500,000 plus $1 million of fair market value exemption. So that's going to bring you to 1.5 million. Well, the house is worth 1.75 million. So you're going to have to take that net between the 1.75 million and the 1.5 million of the calculated exemption and add that $250,000 of net to that parent's transferred $500,000 value property tax basis. So now the child, so long as they move into that house, will be able to will have a reassessed property tax basis of $750,000. So really, they're just adding 250 there. And like I said, the child actually has to move in, and if they don't do it within a certain period of time or claim the exemption that they did so, then there's a full reassessment, right? You don't even get this limited reassessment. All right, so that is the biggest changes, at least with respect to parent to child and grandparent to grandchild property tax changes. But more importantly is kind of some practicalities around here that we'll talk about. And then what we're also going to talk about before we get to that is how they changed it for other real property being passed as well. So when we're talking about other real property, as I mentioned, we're talking about vacation property, rental income properties, anything that's just not the principal residence of the actual transferor. So before the passage of Prop 19, a person could transfer other real property to their child or grandchild up to a value of fair market value of $1 million without incurring a property tax reassessment. However, after Prop 19 and when it goes into effect, they got rid of this exemption. So essentially, if a person after Prop 19 goes into effect here, just in a few weeks, they transfer other property, whether it be during their life or upon death, there's going to be a full property tax reassessment, which is a lot less favorable than what it used to be. So the filing requirement, I mentioned that before. So really, this only applies to transfers of principal residences. To even qualify for that limited exemption, you're going to have to claim the exemption within 1 year of the transfer. But what I think probably the most important thing of all these is really the effective date. So Prop 19, technically, with respect to transfers of principal residences for parent to child and grandparent to grandchild, says it goes into effect on February 16th. So all transfers on February 16th thereafter are going to be subject to this new regime of property tax exemption reassessments. However, what's really important to know is that February 12th to the 15th are holidays, and there's a number of county assessors' offices that are going to be closed during this period of time. So practically speaking, if somebody wants to take advantage of the laws as they currently stand now, they're going to have all their deeds, their PCORs, and other applicable documents ready to go and actually in the county recorder's office by February 11th, if they want to make sure that they get those transfers cleared before the February 16th deadline. Because guys, what could happen is if you don't take the proper procedures in filing or sending these deeds, PCORs, to the county recorder's office, they may not receive them until this February 12th or 15th deadline, and then they won't process them until the 16th. And what's going to happen is that, those people there, they're just trying to turn and burn on deeds. They're not really trying to validate whether you fall underneath the old exemption or the new, and they're just going to say it happened as of February 16th, and there might just be a full property tax reassessment. Then you're going to be stuck in the backseat trying to fight this argument with the county assessor's office showing that you actually filed it before that deadline. And there's ways to do that, if you send it by certified mail and other these things, but a lot of times people are just kind of mailing these things in without keeping that in mind. So this is probably the most important thing. If somebody wants to take advantage of the laws as they currently stand, they should plan on getting those transfer documents in the county recorder's office by February 11th. Okay. So
question.
Go ahead.
That doesn't affect the stepped up basis upon death of a person owning non-owner occupied property, though, as far as the stepped up basis goes. So they can get around this by getting the property at a stepped up basis and selling it and then going buying another piece of property.
Yes, that's right. So if you're talking about income tax basis, that's correct.
Okay.
Yep.
Thanks.
Okay. So what are people doing to what can people do right now to plan around this change in the property tax reassessments, right? So before I kind of get into the irrevocable trust method here, what you need to keep in mind is that most people are only trying to plan for rental properties, because it's still possible to transfer your property tax basis for a principal residence. And, practically speaking, most of the time, if kids are inheriting or receiving the house that you lived in or one of your clients lived in, they're not going to want to live in themselves. I'm just saying, generally speaking, that's not all the time, but there are a lot of emotions that, people don't want to move into the house that their parents lived in. It could just bring up a lot of memories or painful memories. And so most of the time, if we're talking in the context of an inheritance, they're going to sell that property. So even if there's a reassessment, they're going to sell it anyways, not a big deal. They get the stepped up and basis, as Chuck was just kind of talking about, and they can really sell it for no gain. However, what most people are worried about are income producing properties or vacation properties that they want to leave with their children, some sort of golden egg or nest egg or whatever it may be to help them achieve their goals or help their kids out with retirement in the long run. So what can we do now that will allow you to transfer these properties to your children without giving up all your incidents of ownership over it or just giving it to them outright? Because most people still want to retain that property. They still want the income from that property. And maybe they just don't think their kids are even old enough right now to manage it, right? In some circumstances, like if your kid's 35 plus, they're in the real estate industry, not a big deal, you could transfer it. But I'm talking more about younger children here that need property held in their name for which they still don't have the skills to manage. And the way that you can do this by in technically transferring it and utilizing the property tax exemptions now is through the use of an irrevocable trust. So a little context on what an irrevocable trust is. I'm sure all you guys have heard of a revocable trust, and that really is just an estate planning technique. So if you put your assets into it and you pass, you don't have to go through probate. There's already a designated method for how your assets are going to be held and passed on to your heirs. But with a revocable trust, you have the freedom to pull assets in and out, designate who they're going to pass to upon your passing, right? And that's why it's called revocable, right? Because you pull in and out. However, just as the name suggests, an irrevocable trust severely limits that power for you to have that discretion over the assets once they're placed into the trust. An irrevocable trust, as it says, is theoretically, once you put it in, that's how the assets are supposed to pass. You're really not supposed to have any more power over those assets or designate how they'll pass upon your death or even be entitled to the income from it. It's really supposed to be for your beneficiaries. So how do we use this irrevocable trust while still maintaining the ability to have some incidences of ownership of it? Luckily, there are some loopholes in property tax law, estate tax law, income tax law, and gift tax law, because those are 4 different regimes that all have similar but slightly different theories of law that you can utilize. So essentially, what you are able to do as of right now if you have an income producing property, is to transfer this property into an irrevocable trust. But in the trust, you can specify that you, as the grantor or the trustor or the settlor, have the ability to control the timing of income distributions in and out of the trust. And you could still maintain the ability to borrow against the assets in the trust without giving any sort of consideration or, a security interest or a mortgage or something. So essentially, you can still maintain that trust, the income inside that trust, and you can still borrow against it, and it will be completed for property tax purposes, so long as completed for property tax purposes, and you can maintain the current property tax basis, or at least the exemption thereunder, that's in effect till February 15th, so long as you get it done before then. And so it's an interesting strategy. A lot of people are trying to utilize right now. There's a lot of people who want to transfer 1 or 2 properties to their children, one of these trusts, for their benefit. And really, you can just designate how you want it to be held there until you're passing, and then even longer thereafter if you don't think your kid has the ability to manage it. So this is something that's really interesting. But what I think is important to note is that, in this next slide, we'll go into this as well, is that there are some other consequences that come with utilizing this. If you're going to try to take advantage of the benefits that are available to you now, you need to be conscious of other tax implications as well going forward. And what I'm talking about that is really pertains to the step up in income tax basis. Once again, Chuck kind of referred to this. And so as you guys know, when you pass your assets, or if you receive an inheritance, the assets you receive a tax basis equal to fair market value. What that does, it allows you to sell it for no gain. So theoretically, if you had to pay an estate tax, you don't have to pay tax again, right? And there are ways to trigger these transfers that allow you to still maintain that step up in basis for your children, so long as the technical terms or language or jargon used inside the trust is set up correctly. If it's not set up correctly, you run the risk of losing that step up in basis, because you would have transferred it theoretically out of your estate and it's no longer yours. But if you keep the right terms inside the trust, then underneath the tax law, it's still inside your estate, so that when you pass those properties onto your kids, they could still maintain that step up and sell it later for no gain. Okay, and I kind of alluded to this, but the use of an irrevocable trust, guys, it's an interesting strategy. It's it's kind of like that shiny object out there, right? That everybody wants to have, but really it requires a lot of due diligence before you actually use it, looking at somebody's holistic estate planning. And so I guess the long story is that there is ability to use the exemptions right now as they currently stand through February 16th through various types of transfer mechanisms. And there are some interesting strategies out there, but a person should not undertake on it on their own and just hope for the best. Because if they do, there could be some very severely negative tax consequences. Like I was kind of saying, they may just trying to save on property taxes, but at the end of the day, they may end up costing their kids millions of dollars, or not millions, hundreds of thousands of dollars, at least in capital gains, and the taxes related there too, if they don't transfer it correctly. So something to kind of keep in mind as you move forward. And so that is the first bit here on just the parent to child, grandparent to grandchild property tax assessment changes. Is there anything else I can kind of flesh out, at least on this first part? Any questions anybody has? Okay. All right. I hope you guys all got that. I know, like I said, sometimes I can rapid fire. So like I said, feel free to stop me at any point in time, because I know this is complex and there's a lot of information, but what I'll make sure to do is that you guys all have a copy of these slides once we're done, so you can refer back to it later should a question come up. All right, so we tackled the first half, probably the first 2/3 of what I'm going to talk about today. And secondarily here, so, I kind of mentioned this, they really tighten the transfers or the property tax exemptions for transfers between parent to child, grandparent to grandchild. Well, on the other side of Prop 19 is a loosening of those restrictions and actually a more favorable position that's going to be for those who are seniors or disabled or were victims of natural disasters. And so just kind of an overview before I get too deep into this. Before the passage of Prop 19, there was two separate sets of regimes or laws surrounding property tax exemptions for seniors and those for victims of natural disasters. They had their own sets of laws. They weren't really the same. And and now after that, the California decided to consolidate these rules. So now both of these types of transfers or property tax exemptions for seniors and victims of natural disasters fall underneath the same set of rules. So I'll kind of talk about how each one worked before and how it's going to work after the passage of Prop 19. All right. So for seniors, before Prop 19, the property tax basis of a senior, of the principal residence, could be transferred to a new home or constructed home that was complete within 2 years of the sale of equal or lesser value, so long it was in the same county without incurring a property tax assessment. And this was only allowed on a one-time basis, right? So that's for seniors. Now, for victims of natural disasters, prior to the passage of Prop 19, the property of a victim of a natural disaster, and specifically their principal residence, could be transferred to a newly purchased or constructed property completed within a 3 to 5 year period without incurring a property tax reassessment. And there are some value limitations on this, and it really depended on whether you moved intra-county or inter-county. And intra, while I think it's kind of counterintuitive, means transfers within the same, and inter means transfers outside the same county. But they're kind of doing away with this, and it's a relatively complex calculation. So I won't get too deep in the weeds on how those values change. But what is most important in the purpose of this presentation is how these two regimes of property tax reassessments for seniors and victims of natural disasters have been consolidated, changed, and loosened. So how does it work now? So after the passage of Prop 19, this property tax reassessment exemption was changed, right? And it was loosened such that, a person in one of these groups could transfer their principal residence to the purchase of a new home or a newly constructed home that was completed within 2 years of the original sale, that's located anywhere in California. So now it doesn't have to be in the same county for seniors. And for victims of natural disasters, it doesn't have to be inter or intra-county. It can be anywhere in California. The replacement property could be of any values with certain limitations. And now the best thing about this is that it can be used 3 times. So really, what was the purpose of this? Because this is how I help remember things. So this helps me remember. Really, the purpose of this was, at least one of the major purposes was to allow seniors based in California to move up and down the coast without really having to worry about the change in their property tax basis. Because, for example, let's say you have a senior who lives in Northern California, let's call it close to San Francisco. They live there for 80 years. Their property tax basis, let's say it's $200,000. And their kids are now down in Southern California. And they're at that point where they need to be close to them because they need assistance and things of that sort, or they just want to be close to their grandkids. They're kind of restricted because most seniors are, they're starting to lose that income because they're retired. They just don't have the same stream of income coming in, and it kind of restricted their ability to move. And so the purpose of this was to allow them a little bit more freedom to move, move easier without having to worry about the burdens of increased property taxes. And so there are still some value restrictions on how this works for these two groups or these changed property tax reassessments. So just kind of like from a high level, so for purchases or constructions of new property with a value in excess of the relinquished property, the value of the new property that's in excess of the relinquished property gets added on your property tax basis. So just kind of a quick example. I know I don't have one here, but let's say that you have a property tax basis of $250,000 and your house is worth $500,000. that senior now moves to a house that's worth $750,000. So the way that the new property tax basis will be the original 250 plus the net 250 between the fair market values of the house that's being sold plus the new house. So their property tax basis in this example is $500,000. And I think the last thing to note here, or that I really want to stress with the changes in this law, is the effective date. So guys, this is totally separate than the effective date for transfers between parent to child, grandparent to grandchild. And really, these loosened restrictions for seniors and victims of natural disasters doesn't become effective until April 1st of this year. So what's kind of going on here? There's some issues, right? There's some planning issues. And what the calls, at least I'm getting on these provisions, are how can I take advantage of the laws after April 1st? So what if I'm in escrow on a property now, and I want to move, but I want to take advantage of the new laws? Will it be retroactive to me? Should I wait till April 1st? I guess as my message to a lot of people is, if you're in escrow and you're about to close, don't worry about this. You still have an ability at least to get one exemption, and we don't know how California is going to legislate about the retroactive applicability of these provisions.
This one,
so
it's clean.
Okay.
Let's see here.
Yeah.
Okay. And then what's also important to note are those properties, sales and purchases that are kind of right on the hinge of the two dates. So what if you sell a property before April 1st and you're buying a new one after April 1st, at least a senior? What regime are you going to fall underneath? Well, it's not clear. And unfortunately to say, the BOE has a letter out there to the California assessors offices saying that we're going to flesh these provisions out and these nuances out with further legislation. But what I can tell you is that, you're going to want to deal in worlds of certainty. So if you're working with a senior or a victim of a natural disaster, you're going to want to make sure that they complete the sale and purchase before April 1st or before and after April 1st. So you know specifically what regime that you're working underneath, right? Because if not, there could be some uncertainty as to how the BOE is going to come out and say what regime you fall underneath. And I would just say from a California perspective, they tend to be really aggressive with taxes. So what a lot of practitioners are thinking is that if you fall in between these two dates, that they're going to say that you fall underneath a more unfavorable property tax reassessment provision. So that's just kind of my thoughts. Some of the things I think you guys should be aware of with respect to that. And I believe that's all I have on that as well. So any questions, at least on that second set of property tax reassessment exemption changes, or anything else you guys want me to kind of go back over and flesh out?